For the last 15 years, investors made money from three things: falling interest rates, rising profit margins and equity multiples, and thirdly, from just a handful of technology stocks. Today, these three things have changed dramatically. We have a new Fed chair, interest rates are higher than they have been in 2 decades, and the stock market is more concentrated in technology than at any point since the dot-com bubble. And those previously highly profitable asset-light technology stocks are now spending an unreal amount of cash and debt to build out AI infrastructure. Now, the old playbook worked incredibly well. Buy a few ETFs and make sure to buy the dip whenever there was a pullback. The question is whether that strategy is going to work again in the next 10 to 15 years. So today we're going to look at the evidence and discuss what portfolio strategies might work in this new investment environment. Not because the market has to crash, not because stocks are doomed, but because appreciation-only, technology-focused investing has a lot less room for error than it used to. Before we talk about rates, inflation, and the Fed, or even the S&P 500, I want to start with the following chart on wages, because this chart explains more about wealth creation than almost anything that we're going to cover today. All right, consider how these two lines have diverged. For more than 50 years, labor share of income has trended lower, while corporate profits have trended higher. Workers have become more productive and businesses are more profitable, and yet more of the economic output has flowed to the owners of assets. This is a critical investing lesson and something that we need to pay even more attention to in an AI world, because the economy and even the tax code rewards ownership far more than it rewards labor. So if your only income participation in this economy comes from a paycheck, you need to get more exposure to the other side of this chart, because labor is losing ground to capital. It means your portfolio should be built methodically to move you from the labor side of this chart to the ownership side, from paycheck dependency to productive assets. If you own a business, you already understand this. You own an asset that can produce cash flow. Therefore, the goal then is to build more ownership interest around that business so your net worth does not depend on that business alone. You don't want just one business or one paycheck or one overheated corner of the market to be responsible for your entire net worth. That is when the old playbook starts to run into trouble. Now, why is that? Well, let's talk about what changed. For almost 2 decades, cheap money did a lot of the heavy lifting in markets. Stocks, bonds, real estate, private equity, venture capital, all of it benefited from falling rates and easy money. Low rates, lots of money printing from the Fed, and a lot of fiscal stimulus from the government in terms of deficit spending was a giant boost to the economy. Now that backdrop is gone. We cannot keep running $2 trillion deficits at our current debt levels, and we certainly can't keep printing money as inflation is already too high as is. And so you don't have to trust me on any of that. You just have to look at the bond market, which is telling us all very loud and clear that this is going to be an issue. The 30-year Treasury sits about 5%, and that's a level last seen in 2007. So for years, investors got used to a world where long-term rates trended lower and asset prices trended higher. That's a massive tailwind. Lower rates make future earnings worth more. And so every dollar a technology company was supposed to make 20 years from now was still extremely valuable. And so investors were willing to look out a long way and value dollars that a technology company was going to earn 20 years from now and pay a large multiple on those projected earnings today. When rates are low, investors pay up for the future. Lower rates push investors out on the risk curve. But today, money costs more. Debt costs more. Future profits get discounted at a higher interest rate. In other words, they're worth less. That does not mean every technology stock has to crash. It just means that the hurdle rate is a lot higher than it was in the past for these businesses. All right, now let's look at inflation. Core inflation, which has historically been the Fed's preferred inflation gauge, sits around 3.3%. It has stayed above the Fed's 2% target now for more than 5 straight years. That matters because inflation changes the way you should think about risk-free returns. Cash or short-term treasuries feel safe because the dollar amount doesn't move. However, your purchasing power erodes with inflation. If your money earns less than inflation after taxes, you're losing ground. This happens quietly, a little bit every month. It is a subtle form of taxation, a taking of your wealth. All right, now let's look at how that's affecting wages. Real average hourly earnings growth has turned negative again. In other words, after you adjust for inflation, wages are stagnant. The average paycheck is buying less than it did a year ago. And this is a painful combination that a lot of Americans are experiencing right now. Interest rates are higher and therefore debt payments are higher, and yet inflation is still above target. Yet wage growth is not making up for any of that. Therefore, real wages, what you can purchase with a paycheck, are under pressure. Now, this hasn't actually hurt the economy that much because the run-up in the stock market has generated a substantial wealth effect that has given wealthier consumers more confidence to keep spending. But what if the market doesn't keep delivering record double-digit returns? We can't build our portfolios around the assumption that the stock market's always going to deliver record returns. And so if we cannot assume the stock market's going to continue to compound at record rates, then a lot of Americans and retirees need additional income to help outpace inflation. The old question was, how much higher can I grow my portfolio? Now, I would argue the better question today in a higher risk, expensive world is how much income does my portfolio produce and how much of my lifestyle does that income cover? Because that is a very different goal, and I would like to argue an easier way to navigate retirement. Instead of selling stock in volatile markets, you fund your lifestyle from a growing stream of dividend distributions, aka income investing. But before we dive into how that can solve this problem, let's talk about what else has changed. And this is a big one. The Federal Reserve has a new chairperson. The institution that trained investors to expect rate cuts, the Fed is under new leadership and is setting a different tone. This is the shift that many investors have not fully accounted for. Powell's term as Fed chair is over, and Kevin Warsh is now in charge. Whether you like him or not, that's not the point. The point is the tone that he's taking, the policy decisions. He has inherited a very divided Fed with sticky inflation and a bond market that is already pushing long-term rates higher. Case in point, in Powell's final meeting, 4 of the board members dissented, and that's the most since 1992. Those members wanted to stop signaling rate cuts and start defending the inflation target more aggressively. And then what did Warsh do in his first meeting? He focused on the inflation discussion. He didn't talk about cutting rates. He didn't hint at anything. He focused on price stability. And so a Fed focused on inflation with prices above target for the last 5 years is not going to be in a rush to rescue a stock market whenever it pulls back. And that change is critical to understand because the last cycle trained investors to believe that the Fed would eventually step in. Stocks fall, Fed cuts, credit tightens, Fed eases. That was the behavior that the Fed taught investors. But what if that support is no longer there? What if that implied Fed put is just gone? And so this new setup looks different under this Fed chair, and it's already having an influence on interest rates. Just look at the yield curve here. Every maturity is repriced higher. The short end moved, the long end moved. The entire curve shifted higher. In under 6 months, the market lifted the entire cost of money. A 3-bill pays about 3.5%. So portfolios built for cheap money may not behave the same way in a world where the cost of money actually cost money, aka via higher interest rates. That means assets with really high earnings multiples or even worse, sales multiples just on revenue, not profits, they are going to have a harder road ahead. Whereas assets that produce cash flow today are likely to become more valuable because you're not taking as much risk. You're getting a lot of your principal back in terms of income. You don't need to speculate about the future. You don't need low interest rates to warrant those very high multiples. And then perhaps more importantly, those type of income investments offer more downside protection in a pullback given that income, which investors don't like to part with, is often sold off less. There's less selling pressure for those assets in a market downturn or worse, crash. In other words, that high income or maybe that dividend yield sets a higher floor than most assets because it's generating a lot of income that investors love. Now, if you don't have cash flowing assets and you're just allocated to ETFs, then you are likely over concentrated in technology today. Through no fault of your own, it's just technology has been on an unbelievable run. And so a giant portion of the S&P 500 is focused on just technology. And this is creating a problem because most investors believe that they are well diversified. They're in the standard market portfolio today is probably a couple of large cap ETFs, maybe some bond exposure, and those are fine building blocks. But diversification is about owning different risks that produce different return streams that do not move together. If stocks and bonds keep falling during stress events, you might not be as diversified as you hoped. You own the same risk twice, and that's exactly what investors experienced in 2022. Bonds were supposed to cushion a market downturn. Instead, rising rates hurt stocks and bonds at the same time. Now, that does not mean bonds are useless now or that the 60-40 stock and bond portfolio is going to be correlated forever. However, that portfolio construction is just not as compelling as it used to be. Bonds are no fun in an inflationary world with elevated levels of debt. And while we're not going to have a debt crisis anytime soon, fewer and fewer people are willing to lend the government a ton of money at really cheap rates. This is putting a lot of upward pressure on yields. However, I would argue the bigger near-term concern in this equation, this 60-40 stock bond portfolio, is the 60 side, the stock side. And often it's 100% for the investors and potential clients that we talk to, because the most common holding in America is the S&P 500 index fund, and it has a bit of a problem today. This chart shows the scale of the technology outperformance in this index. Technology has not just done well, it has crushed. It has absolutely dominated the index. That dominance has made passive investors feel diversified, while their actual exposure became more and more and more concentrated to technology and now AI. The top 10 companies now make up roughly 40% of the S&P 500. If you put 100,000 into an S&P 500 index, 40K rides on 10 names. It feels like you own 500 companies, but in practice, your return depends heavily on a small group of very large companies continuing to perform. But there's another area of outperformance that's focused on AI infrastructure. In particular, semiconductors are up more than 100% this year, while the overall market is up around 11%. And so when one narrow slice of the market runs almost 10 times the index, that tends to be a giant yellow flag. That doesn't mean a crash is imminent. It's not a great sign that the markets are on solid ground. It tends to mean a lot of future optimism and greed has already been pulled into today's price. In other words, that sector might be priced for perfection. How long can growth rates support these valuations? Are animal spirits taking over? Is greed setting in? I'm not sure, but the following is not a great sign. A memory chip ETF launched in April of this year and became the fastest ETF ever to reach $15 billion in assets. This is unheard of. The overwhelming majority of ETFs never pass $100 million in value, and they rarely reach $1 billion. And if they do, it takes them quite some time to reach $1 billion, let alone $15 billion. And so this is not exactly patient capital, carefully considering risks and slowly underwriting cash flows in a thoughtful manner. This is money sprinting with its hair on fire into a theme. Come hell or high water, they're buying. Valuation really doesn't matter here. Again, the theme is real. AI is transformative technology and memory is in short supply, and these AI build-outs need a lot of memory. And so demand is overwhelming these companies, and so their prices and their stock prices are just soaring. I don't think there's any doubt that AI is going to change the world, but valuation and price is going to matter again at some point. For all we know, these memory stocks might continue to soar another 10x, but I do know that the embedded risk in these prices is much higher now than it was just a few short months ago. So I'm not telling you to sell everything. I'm just saying that we should all know what we own and should probably reposition or rebalance our portfolio when the opportunity set changes. If all of our favorite cash flowing investments 10x in just a few short months, I'd want to reposition our client portfolios for those stocks too. Therefore, if your core portfolio consists of a concentrated and expensive bet on a small number of technology companies that are shoveling just mountains of cash flow into AI infrastructure at record numbers, record pacing, you might want to think about taking some risk off the table with your net worth, because you might have more risk than you're comfortable with. Because the problem is not owning stocks. We own stocks for our clients. We just focus on high cash flow, dividend paying stocks that are in boring industries with some sort of moat, some sort of defense. They have pricing power and they're not dependent on AI changing the world. And we like that dynamic because with income producers in your portfolio, your net worth stops relying on appreciation alone. And that feels especially good today because we're not so sure about the appreciation of the stock market in the next 10 years, because the assumed giant profits from AI may or may not materialize soon enough to justify these record valuations. If the expectations are high enough, even great quarterly results are met with large drawdowns just because those assumptions for profits were too high. And I would argue we are probably in that situation today with AI infrastructure stocks. And if that's the case, that's where income investments tend to support portfolios. They can help soften the blow in down markets and hopefully set your retirement up for monthly growing income without having to sell any of your principal to pay for your lifestyle. I think of it like owning a business that pays you indefinitely yet requires none of your time. It's like when you retire and give the business off to the grandkids. And this is how most family offices tend to invest. They don't want to sell assets. They want to compound that income indefinitely to fund current and future generations. All right, so where does durable income come from? For us, it comes from a lot of hard assets and contractual cash flows. Hard assets are physical, tangible assets with a real world use. Real estate, infrastructure, utilities, energy, certain operating businesses that deliver goods and tangible services that aren't just ones and zeros on a computer screen. The appeal of these assets is they're not magic. They have risk. Every investment has risk. But the appeal is that the return is often tied to cash flow, contracts, collateral, essential demand rather than only market sentiment. This is not a trend. These assets have produced cash flows for decades via long-term contracts, regulated returns, or demand that's not going to disappear if the NASDAQ has a bad month and buyers get skittish of their AI spend. And these contracts typically adjust with inflation. When prices rise, the income tends to rise higher along with inflation and ideally outpaces it. And most of these assets and businesses have a long track record of raising prices faster than inflation, which feels much different than sitting in cash and watching inflation erode your purchasing power. Again, not risk-free, but different sector risk, different return drivers, a different way to get paid. Assets that can still generate income when the market is 20% down in 2 months, which is a dynamic and an attribute that I think is underrated because most people think investing has only 2 jobs: protect the money and grow the money. But that's missing the 3rd job, which is pay you the money. The entire premise of investing, even those high-flying tech stocks, they eventually have to pay you actual cash flow, either through future dividends when they mature or a dividend that you create yourself each month by selling shares. And from what I've found is most people just focus on the growth, and especially when markets are hot. But eventually rosy projections and appreciated portfolios need to convert to cash to fund your lifestyle. It's not going to be funded by account values on a screen. Unfortunately, we can't time our expenses with how the stock market's doing. The expenses come regardless. And so if your portfolio doesn't produce enough recurring income, at some point you're going to need to sell shares at valuations that you're probably not happy with. Not all the time, but sometimes you're going to be in a market that's down and you're going to remember when you could have sold it at a higher price, which is just not a great feeling. Everybody loves upside volatility, but nobody likes selling into a 30% drawdown. It is a lot harder to pull the trigger at that point. When you're forced to sell assets in a downturn and that paper loss becomes permanent, and then you can have a cascading negative effect on your plan if you get unlucky on the timing, the sequencing of returns is what that's called. Most investors underestimate that risk because they're used to living through drawdowns while still employed. A 30% drawdown feels different when your stock portfolio is your entire net worth. You can't make up for any losses that you have in the near term with new paychecks coming in. Now, don't get me wrong here. The goal is not to try to predict when technology stocks are going to peak or when a large market drawdown is going to occur. The goal is to avoid being forced to sell when that happens. That is where income changes the dynamic and helps people stay invested through market volatility, which typically leads to dramatically larger portfolios over time by reflecting that good investor behavior. Because if you can live off the income that your portfolio is producing, then a bad year might become uncomfortable, but not catastrophic because you're not having to sell stocks that are in a drawdown. And then you have the added benefit of probably not checking the market every day to see if your retirement still works. You have the cash flow, you have income that you never have to sell. And that brings me back to the first chart, labor versus ownership. We want to think of our portfolio like a business. The goal is to own productive assets that move you to the ownership side of the economy. I think of it like little warriors that go out in the middle of the night and go fight for you and bring back cash flow for your family. That is the paradigm shift in markets that I think we have to deal with today. It's going from appreciation only growth focus to appreciation plus income. Therefore, speculative assets that don't produce a lot of profits are built for cheap money and face a more difficult road ahead. So if appreciation becomes harder to rely on, income is going to matter more. The growth-only playbook worked remarkably well the last 15 years. And so if you want to see how we structure portfolios around durable income instead of appreciation alone, the link is below. Thanks for watching.